and make sure that they remember forever the night they played the Titans.
Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, August 26, 2022. S&P 500 currently sitting at 4101. I'm David Zarling. I'm here with our resident hitting instructor, Ian McMillan. Plenty to cover this week. Follow through from last week. We talked about weak seasonality heading into last week or this week. A falling 200-day moving average. Where do you want to start, Ian?
Yeah, kind of I guess a lot of nothingness for the first few days. We gapped down on Monday.
Yep, gap down on Monday. And a gap down means, I should be careful, gap down meaning the opening price on Monday morning.
Stocks gapped down, yeah.
They didn't open at the same price they closed on Friday. They were further down than that.
Pretty decent gaps. And then, I guess sideways for the rest of the week with a lot of attention on some things. I guess Jackson Hole is today, not something we pay a ton of attention to.
Wait, you're not a mind reader?
I'm not. Right. I mean, I just rather, much like you, just rather see what price says in regards to how the market feels.
Oh, I see. I thought the process was supposed to be read the minds of some individuals on the Fed board and then make an allocation. That's not what we should do.
No, I mean, I'll stick with the trend following.
Okay. All right.
So far, I mean, a pretty unfortunate, whatever you call it. I guess they didn't like what old Jay had to say this morning.
Jay Powell.
The old Jay Powell. And, sitting right here at the lows of the week. So like you said, you could certainly call this, as of right now, follow through off of last week's pretty lethargic. And I mean, last Friday was pretty gross, also a gap down. And it's kind of this, similar action to what we saw you remember that like early mid-June, like June 9th and 10th.
Yeah.
And 13th.
Right.
So now, right, we ended up bottoming here on the 15th, but similar Monday through Friday action.
Yeah, it does make you wonder about the price action since mid-June, which was a bottom. And we've always been careful on here to call it a bottom versus the bottom. And it could turn out to be the bottom. We don't know. We still don't know yet. But markets are a future discounting mechanism. And I know the way the media likes to cover it is, because we just talked about Jay Powell and Jackson Hole and those type of things. And the media will take this one day reaction and say it's 100% associated with Jay Powell and Jackson Hole. And I'm sure I can only imagine what's happening on some of the major networks as far as interpreting what so-and-so said. I can only imagine. But remember, markets are a little bit smarter than just day to day. They're not just a one day reaction and that's it. So yes, many stocks are negative today. They're red today, Friday, August 26, 2022. But when we look at the big picture, right, we should never just look at a day. We should be looking at the big picture. And the big picture remains the majority of stocks in a bear market since February of last year. Yes, there's been a rebound since mid-June. Absolutely correct. But hasn't really necessarily fixed anything with your larger capped indices like the NASDAQ and the S&P 500 correcting since the beginning of the year, since beginning of 2022. And we still have falling 200-day moving averages. I don't know if it's that easy. Like you got a falling 200-day moving average and we touch it on August 16th.
Yeah.
And we reverse lower. I don't know that it's that easy.
But
if that makes sense. That's what happened. We have falling 200-day moving averages. The S&P falling 200-day moving average price touched it and reversed.
I think Russell got above, quickly reversed. NASDAQ never got there. And I think Dow similar to Russell, got above for a bit. And then last Friday got down below and like everything. And right now we've got, again, if we were to close here today, all four major indices would close below those late May, early June highs. Those consolidations, if you look at charts, you know exactly what Dave and I are talking about. So we'll see. It's a big, big area that the average stock was not able to hold. And now, right? And we talked about Apple being a headwind. And I would say that's probably changed in the last 5 to 6 days.
Well, in that last podcast, we just talked about the risk reward scenario with Apple.
Yeah.
Is this really where you're getting long?
Mm-hmm. Here at this overhead resistance, all the energy that it's spent to go on this, I don't know, 35. How much was it? 35%?
You're just talking about
the 2 months.
The controlled move from mid-June.
Yeah.
I mean, it's a 35% move in a controlled fashion. That we've broken that near-term rate of trend. And what I'm talking about is just the daily price movement of Apple since mid-June. The 35% rally that took us directly back into the 175 level for Apple. And the 175 level to 180 level is super important. And that's why we study price, because there's a behavioral aspect to this, right? When you talk about resistance, what you're really talking about is like, this is where supply shows up. Why does supply show up? Well, guess what? If you bought at 175 or 180 and Apple gets back to that right? Because if you bought Apple at those levels and you're experiencing like a 20-25% correction, you get back to even, what's the human nature reaction? Thank you. I'm back to even. I'm out.
Yeah, I'm done.
And so that's why these horizontal levels, these levels that are at important price points for Apple, that's 175 to 180. That's why last week we were talking about it doesn't necessarily make a lot of sense from a risk reward standpoint. Did we know that this week would unfold like this for Apple? Absolutely not. Who knows that?
I had no idea.
No clue. But we know where there's scenarios where, and it's like anything in life. It's one thing to walk on a balance beam that's 4 inches off the ground. It's another thing to walk on a balance beam that's 40 stories in the air. That's two different levels of risk. And so we can say, by studying price, we can identify, are we stepping on a balance beam that's low to the ground and we're not going to take a lot of risk here? Or are we standing on a balance beam that's, if I fall off or if this position falls off, it's mortality? That's why we use price, because if it doesn't make sense to be involved in that until it's above a certain level.
No, I would say that the market, and in particular Apple here, as it got up, as we got into these extended, whether it was a 200-day, whether it was some type of overhead resistance, given the broad environment of the market, I still think that risk on assets to me are in prove it mode. Like a 15% rally off the lows doesn't quite tell me that the coast is clear.
Well, and that goes back to, and I know someone we have an appreciation for, at least for their mindset and how they think about things, is Brian Shannon. He would always talk about how much energy did it take to get to this point. And if you used up just like a ton of energy, is there enough energy to finish?
And sometimes there is. Sometimes things keep going up.
Right.
But again, it's about what is the risk reward? What is the probability of, Apple up 30% 35% in 2 months is a strong, strong move.
Well, and it's the last of the Titans.
It is.
Right. When we look across the things, when we look at the makeup of something like the S&P 500. So
let's some good notes on that. Earlier today, as you as I were going through charts and talking about some of these large and mega cap tech, I mean, you were spitting them off, Microsoft, Google, all these other things that have absolutely not held up as good as well as Apple has.
Right. It's definitely the last Titan. And it's one of those things where if we paint the big picture, if we just look at the big picture, okay, big picture being even to the point of like, how is the S&P 500 made up? What are the things that are in the S&P 500? And what is their weighting? Weighting being what's the slice of the pie that they are. The big guys, the big pieces, if you slice up a pizza or a pie or whatever, Apple's like 7% of the S&P. Microsoft is almost 6%. Amazon is about 3.5%. Tesla is 2%. Google's about 4%. There's some big pieces. All of them, all these Titans have fallen off since basically middle of last year to fourth quarter of last year. And what I mean by fallen off, I just mean they've underperformed the S&P as a whole, with Apple being the last one. Apple's the last Titan. And if that falls, I believe we referred to Apple as Goliath. If Goliath falls, it's going to take the entire market with it, because it's really hard to overcome 7% of an entire index. And that's what you see at market tops. I mean, I don't mean to be fear mongering, but when we look at, 07, 08, it was the JP Morgans of the world, Goldman Sachs of the world. Right. And they were, once those heavy weighted financials started to fall, it took the rest of the market with it. But it's always tough to talk about, because immediately when you talk about 07, 08 or 2000, 2001, people freak out. I get it. Every bear market, though, has its own characteristics.
Yeah, I mean, JP Morgan was, trying to push for a breakout in October of 08.
Right.
I mean, this thing was sitting at its best spot, 49, trying to break this 48 level, early October of 08. And, meanwhile, a lot of the other pieces of the market are well already to their lows. And then this was kind of that final piece.
Yeah, it was definitely one of the final things that was holding up and that's when you think about slices of the pie or slices of the pizza, the largest pieces then in 08, 09 or going into 08, 09 were financials. And JP Morgan, Goldman Sachs, Berkshire Hathaway, those were the apples of the time.
Mm-hmm.
And so here we are. If you're observing market behavior and you're trying to determine the depth or severity of a correction. Now, and I want to be very careful, because Apple just went out to new relative all-time high last week.
But see, now I definitely hear what you're saying, and that's good. But couldn't that have also been? We saw Apple continue to act pretty well relatively during the COVID crash.
Oh, for sure. Like it does seem to be the last, like an island of and we've talked about this in the past, as far as, is Apple a risk-off refuge for asset managers?
If you've got to own tech, or you've got to, it's a lot less risk-off, I would think, as far as if everything goes to heck in a handbasket, will this company be around in 18 months?
Right, exactly.
If I'm a PM and I'm sitting around, contemplating the world, yeah, Apple probably gets thrown in that basket with a lot of other staples and utility companies.
Yeah, because can I go to Apple? Meaning, when I say go to Apple, can I purchase Apple stock and know that I can turn around and sell it and have a liquid environment, 100%. It's one of the most liquid stocks on what probably actually is the liquid stock on the planet. So if I'm going to hide out as a PM or a portfolio manager, I can be in Apple in a lot of different scenarios, whether I have a large cap mandate, I just have simply an equity mandate,
growth
mandate.
And no one's going to yell at you. No one's going to say, you idiot, you held Apple down like during this 40% decline.
Right.
Now, as a technician, we would. But as, you open up your statement, no one says, oh, what an idiot, he owned Apple.
No. Apple's too loved.
Yeah.
Apple's a name brand. I mean,
isn't it wild how people will accept losses in Apple versus like, oh, well, if Apple did bad, I guess the whole market's bad. But other things.
Right. You could have owned some random company named Heiko. And if it's got a loss, well, why'd you own that? Versus, oh, you have a loss in Apple. You got to own Apple.
Yeah, you got to own Apple.
I mean, how would you not own it? I mean, I don't. So they have their own USB cords. How would you not own Apple? It's interesting that when we look at markets and when we study the individual components and when we actually recognize what's going on big picture, correction since February for most stocks, February of last year, 2021. And I think it was last week, we talked about infantry, lieutenants, and generals. We really are down to Apple as being the last leader.
I mean, it's it.
Everything else, maybe Tesla, maybe.
There's other individual names that look okay, like Albemarle. Okay, great. Albemarle broke out to new highs yesterday. But is that going to move major indices? No. Yeah, 100. No, you're absolutely correct when you say that. But you're right. I think you're spot on. It is. I just feel like it's Apple standing in the middle of a battlefield. All these other soldiers around him are, all of his fellow cavalrymen are just, like that scene at the beginning of Gladiator. And it's just a field full of bloodied bodies, swords and spears in them. And then there's just Apple, this lone soldier in his armor. And it's all that's left.
No, exactly. Because when we look at the other big pieces, the Microsofts, the Googles, the Metas, otherwise known as Facebook, Amazon, Taiwan Semiconductor, these are the larger ones.
You want to talk about a name that didn't even bounce? Facebook, zero participation in any of this broad equity rally.
And it really is Apple that's left. Like you talked about Albemarle, ABL. It's not even in the S&P 500. So you're correct. It breaks out to new highs. It is performing well. It is not going to impact the S&P 500 at all. Like zero impact. And
even a broader, example of that is energy. Energy kind of had a decent week.
Yeah, it did.
Broad market sucked because energy has such an insignificant impact on what it does. But yeah, energy compared to the rest of the market, we'll see what it does next week, but it continues to be like this lone area to hang out.
Well, and isn't it fascinating that the best performing sectors this past week, and actually people should look at it year to date, energy, utilities, and materials, they are, I don't want to say insignificant, but they are super small in size. So for example, energy as a sector, the sector overall, energy in totality inside the S&P 500 is about 4.5%.
And Apple's worth 6 or 7? 6?
7.
7.
So all your energy stocks could go one direction. Apple could go the other, and Apple's going to have more impact than energy as a sector. Think about that. Apple stock has more impact on something like the S&P 500. And that's why it's so good at hiding some of the stuff that's happened underneath the surface over the past year and a half.
Yeah.
Right. Just because Apple has done well, it's hidden the carnage that's gone underneath. Like there is no doubt about it. There's been a bear market, but most people associate it with year to date when it's really gone on 18 months, 17 months, or like 19 months. Materials, 2.5% of the S&P 500, utilities, 3% of the S&P 500.
So those three added up, what's the total between those three added up?
Let's see, 7.5 plus, so about 10.
So Microsoft and Apple together easily.
Right. So Microsoft
and
Microsoft and Apple, two stocks, have equal to or just a little bit greater than impact over energy, utilities, and materials combined. That's momentum is really what that is when we're talking about that.
Years of momentum and market cap weighted indices.
Market cap weighted indices. It's huge. And I know we worked on a project that we kind of, our eyes were open as far as how we always knew about capitalization and momentum, but just as far as how certain things looked prior to, let's say, 2006, prior to, let's say, 1988.
Yeah.
There's some differences here as far as how indices were calculated. And we are definitely, from an indice perspective, looking at S&P 500, NASDAQ, it is cap weighted momentum, which means it's in favor of momentum characteristics. So your bigger get bigger and your smaller get smaller.
And that's all fun and games until the tide shifts.
Correct.
Now that momentum and those big names like Apple and other mega cap names are now working against you.
Right. Because when we look at the top 10 players or the largest pieces that are left on the chessboard, the king that's left is Apple, but everything else is off the chessboard. And so you sit there and go, is this checkmate on this market? Until the king falls, Apple.
Yeah, and that's hard to say Apple. I mean, right? It just came off this big rally. Yes, we've pulled back here. I mean, it's hard to say that this is the beginning of the end.
It really is. That's a thesis. We will not know that until later. However, we can speak in terms of if this, then that. For example, S&P 500 as a whole, as a group, below 4180, which is a level we've talked about for a long time. So you're below 4180, which is an important behavioral level that goes back in time, along with a falling 200-day moving average. The thesis is ongoing lower prices.
Yeah, and because you still got lower highs and lower lows on the major indices and on Apple itself.
Right. And if Apple
slightly lower low or lower highs, but they're still lower highs.
Right. And distributions of things like Apple can take time.
I mean, that's trillions of dollars, man. It's even more synthetically. I mean, it's
right. It's a massive, massive capitalized. I mean, Apple's, I'm going to say a term here, Ian, careful, balance sheet has cash on it that most countries don't.
Yeah.
And the stock itself, there's so many shares in circulation that to be distributed will take time. I'm going to say we haven't seen this type of capitalization ever. And I'm willing to be wrong in the sense of it's top three for sure. In the sense that the weighting within an indice is one of the biggest we've ever seen. And if Apple fails, that's it. And probably by this point in the podcast, most listeners are like, man, these guys are spending a lot of time on Apple. Well, here's why. It's the last one. It's the last piece standing.
And short term, it's broken again.
Right. It is the final piece of the puzzle when we look at what do bear markets look like. Tops of bear markets, it's when the prior leadership, so in this case, tech, large cap tech, which was the prior leader. And what do I mean by that? So if we just take something like the NASDAQ 100 versus the S&P, it has been outperforming. So the NASDAQ 100 has been outperforming the S&P since 07, like a breakout in 07. And that difference is about 145%, 150% difference. Those are that So notice the period I'm talking about, '07. So that's the end of the prior cycle, bear market, which was financials. Tech takes over. The baton is handed during that bear market to tech, large cap tech. We rally a huge amount. If you're going to see a protracted, a multi-month years bear market, large cap tech has to fall off. And we've seen that the soldiers fall off the chessboard between Google, Facebook, Microsoft, Amazon. These things have continued to fall off, with Apple being the last one. So it's the final linchpin as far as our analysis goes. Is that a fair assessment, Ian?
I think it's a fair assessment. And again, the market remains, I know we had this nice rally right back into a lot of falling moving averages and horizontal resistance. Yeah, I still think, and Bitcoin has acted. I mean, it's been pathetic throughout this entire.
No, this is great. Thank you for pivoting us towards something else other than Apple and the market.
I mean, Bitcoin continues to, it rallied, I guess, we've talked about it last week, struggling at this anchored VWAP from the COVID lows, and then really struggling now again at this 22,000 level. I mean, I hate to put it out there, but yeah, I mean, you break, right? We get back down to 19,000. You get through 19,000. I mean, you're looking at what, 11, 12,000 maybe?
Yeah, I was just going to say 11,000, 12,000 is a really important horizontal level on something like BTC or Bitcoin. And that's really what this targets, this consolidation / flag that's taken place since June through now, that broke basically last week. It's important to note that breakdown last week, I mean, we're targeting a level in Bitcoin that's 40% yet to go, 44% yet to go.
Which sounds nuts, but
this is how compounding math works.
Mm-hmm.
And why would we act surprised that that's a possibility? Because this is markets, baby. Like you think market dynamics only apply to equities, bonds, and commodities and currencies, but don't apply to crypto?
Probably more pure on crypto.
Right? Fear and greed still exists. It's not like the human condition has changed. It's not all of a sudden somehow the human condition has reached utopia. Fear and greed, which has gone back to Adam and Eve, still exists.
Well, and there's nothing outside of supply and demand. I mean, there's no dividends to factor in. There's no external, so-and-so stock is down because the CEO stepped down, or they got bought out, or they've got some new pending FDA news. I mean, it's just people buying and selling.
And based on their opinions, and it's still a future discounting mechanism. Some people are buying because they want to yield farm. Some people are selling because they just need to put themselves through college. So, the same factors come into play for supply and demand that have for any other instrument. So to pretend that somehow crypto is exclusive to those, that somehow the human condition has changed, or the reasoning behind buying or selling something has changed, is naive and frankly incorrect. Because the same dynamics come to play in anything that's liquid. And that's the beauty of markets, right? Like, I have no complaint here. If Bitcoin wants to jump 40% from here higher, more power to it. I don't care, whatever. But the fact remains that 44, 45% lower does seem like a possibility based on studying supply and demand on a chart and identifying where there's more risk than reward. Because isn't that really what this is all about? Is identifying, am I in a situation where my car is parked in the garage, or am I in a situation where I'm driving 120 miles an hour down the road? Those are two different risk characteristics. Do you have a process for identifying when you're in those two different scenarios? Many don't, but we do because of technical analysis. I cannot imagine managing assets without technical analysis.
Yeah.
You're just going to interpret what some dude named Jay. And I don't even know if that's his nickname. Is his full name Jason? Like, is Jay on his birth certificate? I have no idea.
Jerome. It's Jerome.
Oh, Jerome. Yeah, that's right. Jerome. Jerry. How come no one calls him Jerry?
Probably not professional enough.
Okay. But my point being, we're going to interpret what one dude says and make an allocation on behalf of clients based off of that. That seems
So
a
you're
little
like
bit
changing everything now. Like I feel no different about the market today than I did yesterday.
Right. It seems a little irresponsible that we would be basing it off of Jerry's comments. I feel like we maybe should be a little bit more responsible and use actually.
Opinion.
Yeah, we might want to use the market as a whole, the collective. We might want to use supply and demand to identify when risk outweighs reward, and when risk outweighs reward. Right, as one of the things that makes it hard to parent a teenager is because teenagers have a very hard time diagnosing when something has too much risk versus reward. But because we're mature and can use price, we can diagnose that in a market. So are we going to act as a teenager and not understand the difference between risk and reward? Or are we going to act like adults when we're involved with the most competitive arena on the planet, markets, and identify when risk is too high? Because you only have so much inventory. Like the assets that you have in your account, that's your inventory. You run out of inventory, you're done. So are we going to manage accordingly, or are we going to act like teenagers? I choose price. I choose price to manage risk and reward. So I've soapboxed a little bit there, Ian.
No,
and you did a really good job pivoting us from equities to crypto. What else could we pivot to provide our listeners some great insight and information?
We got rates still hanging out up here. They're still above what I would say is their 30-year. They're still broken, quote unquote, their 30-year, rate of trend. I guess more like 40-year rate of trend to the downside.
Are you talking like 30-year treasury yields?
30-year treasuries until we get over 3.5, though. I don't.
Yeah, 3.4
until we get it over 3.5. So we'll see. And this could also be a pause. I mean, it's been a big run for rates. I mean, we're going back to the COVID lows is when rates bottomed, and they've been in an uptrend for 2.5 years. They've had their pauses along the way. So if this is just another pause, but they've held up well. Bonds, TLT, again, back to lows, trying to save itself down here. This 112 area, it's where we bottomed in Q4 2018. So we'll see if we hang on there again. And that's treasuries. Junk bonds follow through from a pretty nasty candle last week. Big nasty candle on junk bonds last week, and not that great again.
Yeah, no reprieve. And so when you think of like risk on, risk off, Ian, what you're saying is you started off talking about treasuries and treasury rates, but now you're talking about, there's a reason why they're called junk. These are the higher risk areas of bonds.
And they look like everything. They rallied with equities and they're rolling over with equities,
which is typical.
Yeah.
When you risk off environments, we see junk bonds also fall off. But what's interesting, and man, how many times have we talked about this? Just that bonds in general have not cushioned the things that have happened in equities. Even if we look at something like AGG, which is the aggregate bond, which is one of those things which I believe in the past, since its inception, has only had one other negative year return wise. And here we are in another one. And the last 2 weeks been pretty not so great for.
Yeah, they have not rushed to buy fixed income with this recent equity sell-off this day. Now, TLT's up a bit today, but.
So what has been, we haven't touched base on commodities. When we look at.
Gas continues to hold up. Oil still below 95 a barrel. There are some perk ups this week and things like grains and other agriculture related, kind of holding up okay.
What about some of the mining names?
Corn trying to get out of this base. Mining, yeah. And definitely more of the base metals than the precious metals. Precious metals still pretty weak. Like steel, aluminum, we're holding up there. Again, some of these, these are red today, but still relative leaders over the past few weeks.
So there's some strength in the commodity space. When we look at commodity related stocks, we generally are seeing your energy producers, companies involved with energy, whether it's crude or natural gas, do better than those who are pulling precious metals out of the ground. And then those who are pulling industrial metals out of the ground are doing better than the precious metal miners. And this is what's interesting is this is still happening in a dollar strong environment.
Yeah, dollar, great point. Dollar continues to hold. I mean, it's sideways week this week, but still continues to, it's follow through from last week. It's going to be weekly closing highs.
Yeah. And what we're talking about here, just so I'm clear for those listening, we're talking about a trade weighted dollar. Okay. So it's imagine a slice of pie or a whole pie, and it's comparing the dollar versus other currencies in the world and how they're used. A trade weighted dollar. Now, I don't want to sit here and pretend that if you're based in the US, because we have many listeners from everywhere, but if you're based in the US, that somehow your dollar is stronger. I get it. If you're going to the grocery store and you're paying more and you're paying more for energy, you're sitting there saying, how can these guys possibly talk about stronger dollar? What we're referencing here is the dollar compared to other currencies.
Yeah, think about it. If we had a weak dollar, think how much you'd be paying at the grocery store.
Right. It'd be even worse.
Yeah.
Some of the energy prices that we're seeing out of Europe, because here's the trade weighted euro is just getting crushed. Like we look at what's going on with the euro, it's even worse. And that's why you're seeing just crazy quotes for what it's going to take to pay for a kilowatt of energy in Europe. It's pretty impressive. And it's because the euro is so weak. It's so weak. And we've talked about that in the past, right? Like if there was a time to potentially take your significant other to Europe, now's the time. And it's because of the strength of the dollar versus the euro. I mean, the euro is going to go out at another new, fresh, weekly all-time low compared to the US since
we're still
2002. We haven't been this low in this relationship since 2002, 20 years ago. These relationships
and there's
matter.
Really there's no support there till.
We could be talking about spot 80 cents.
Yeah. And within the next year.
Right.
Depending on what rate we go,
And so when we talk about dollar strength, I just want to be careful because I know we have received some feedback from clients like, how can you be talking about strong dollar when I'm paying X at the grocery store? That is absolutely 100% a fair thing to say and 100% true because
but the two are not mutually exclusive.
Correct. We're just talking about dollar strength versus other currencies. And it's notable that against almost every other currency is stronger over the past year. And this strength continues and we continue to see it. And it's fascinating to observe that because most textbooks would teach you that type of dollar strength, you would see weaker energy stocks, weaker energy overall. And that's
maybe we eventually will. Maybe that comes to fruition, but it sure has not yet.
No. And same thing with the textbooks teach us stronger dollar, stronger bond, stronger treasuries. And that relationship has broken down. And this is why you can't just marry these relationships because market's going to market. Like they're going to do what they do. Like you can't control what markets are going to do until you go ahead.
What does rising rates mean for every other? We've gone through 40 years of one of the most important assets being in a bullish regime, bonds.
Yeah, right. That's the biggest asset, is it not?
No one knows what a 40-year rising rate environment looks like for all these other things, and it's not going to be figured out overnight.
No.
Assuming that we do go into, that's what bonds and rates move in these 30, I guess it's probably a little bit closer to 30 years, isn't it?
Yeah, it's a 35-year cycle. Yeah. Wheels within wheels, there are cycles.
Is this mean dollar up is good? I don't know. But I guarantee you when I'm in my 60s, I'm going to be sitting back and saying, oh, wow. So that's how that played out, huh? So this is what rising rates meant for XYZ. But you don't know that until you get to the other side.
Right.
Or at least I don't. I'm not going to sit here and try and pontificate.
No.
And
it's a dangerous place.
This is what this means for this ass. Like,
yeah. It's a combination discipline. It's art and science combined, right? Because flying a plane, is that art or science? It's both. Same thing with using price. The idea that every intramarket relationship, and what do I mean by intramarket, right? Because you do intramarket analysis. Okay, we got a strong dollar. That should mean that some commodities go down, or all commodities go down. Well, in this instance, this current market environment, yes, precious metals are down and the mining companies associated with it, but not everything. Natural gas is up. Oil is up. So it's not a one-to-one. And that's where it gets back to take each chart on its own merit. Yes, do intramarket analysis, but don't get so caught up in it that you're confused by the fact that one would do. Markets change all the time. They're markets. It's like anything in life. There's fat tails. There's non-zero chance. You can't create some type of model where it's just two inputs that are one-to-one and that's it. I mean, that's how long-term capital management got in trouble, is because the yen carry trade, lever up on a yen carry trade, and you get slammed because of that 1% event that happens that completely wipes out your book. You can't do that. You just can't. It's markets. All right, Ian. So we're at the 45-minute mark. We've covered equities, crypto, bonds, some commodities. From a weekly perspective, we're seeing follow through and price action. Big picture perspective, we're seeing falling 200-day moving averages, price reactions to them. We're seeing the S&P 500 currently below 4180, which we've talked about in the past. Anything else that is worth highlighting or touching base on before we ask our listeners to give us a high ranking?
I would say utilities in their failed breakout, but then also on a failed breakout on an absolute basis.
Oh yeah, I see what you're saying.
Not that utilities are the smoothest trending sector, but then also, I mean, so that failed breakout on an absolute basis, and then utilities looking like they would like to march towards new relative highs, I think is something that no
100%.
bull wants to see.
I love that you're
see defensives breaking down, but then also doing better than the broad market.
Yeah. I love that you're bringing this up, because you're saying that utilities on an absolute basis, so not comparing it to anything else, just failed this week. It had created a new all-time high, closed back below the prior high that goes back to April of 2022 this year. We failed there, but on a relative basis, holding up okay. At a pretty important level that goes back all the way to the 2000s. If
you're bullish, I don't think you'd like to see them holding up well.
Well, correct. Like utilities outperformed in the crash of the 2000s. Utilities outperformed in the crash of 07, 08. I use crash as such a hard term. Corrections, bear markets. During those periods, utilities did great. And so Ian's saying from a defensive sector perspective, I'm not sure that you want to see utilities outperform at this point.
No, not if we're really going to be ripping off the lows.
Anything else?
No.
Okay. So here we sit, falling 200-day moving averages domestically. Internationally looks even worse. S&P 500, the largest, subject to large cap weighting, below 4180 currently. That can change the next hour and a half. I'm open to that. And that would be huge information. The last piece of the puzzle yet to fall is Apple. If that continues, protracted bear market, meaning months to years incoming if Apple holds up and these other pieces, right? Because, for example, if Amazon is able to get itself together and stay above, get back above and stay above the 138 level, if something like Microsoft can not fall apart and get back above 275, these would be things that would hold the broad indices up. Until then, though, a little bit of trouble. Ian, appreciate you. Appreciate everybody on the Adaptive team. We appreciate everybody listening as always, or as we move forward, we're going to ask people, give us a high ranking on whatever platform you're using to listen to this podcast. It helps us get the word out. That's full disclosure. We feel like we provide relatively quality information on a weekly basis and doesn't cost you anything. And so in exchange, if you could give us a high ranking that helps us get the word out, we'd really appreciate it. Otherwise, Ian, appreciate you. Appreciate everybody on the Adaptive team. Looking forward to the weekend ahead. And we wish everybody listening to this a fantastic weekend.
Have a great weekend, everyone.